in the interest of time, I'll now invite our another esteemed panelist, Mr. Mohamed Manjang, to also delve into his topic. Mr. Manjang, you have about 30 minutes.
Okay. Okay, I thought somebody else was gonna go. Let me, I'm supposed to talk about the options available around retirement portfolios.
Correct.
But I thought I'll just make it a little bit wider. I've got a couple of slides to share with you.
Okay.
I thought, I'm not sure, yeah, I guess you're seeing it now. So I just thought I'll make it a little bit wider to talk about retirement planning itself than just specifically on Social Security. But clearly we'll touch on Social Security. The reason I'm thinking retirement planning, because retirement planning in the Gambia, it's complex. It's complex because of the demographic shifts, but also because of the economic and social factors. And that actually makes retirement planning very challenging. And I think it is very important. I know a lot of people seem to see retirement as being further down the line, and it's not top of mind for many people. But it's a very important topic that people should really be mindful of and plan at an early stage. So that's my topic. I just want to start by just looking initially at what the benefits of a pension system is. I think what comes to mind to everybody is the core objective of a pension, which is the protection against the risk of poverty in old age, and also to smooth consumption from one's work life to retirement. Generally, this is what many people look at pension funds and say, these are the benefits of pension funds. But clearly, pension funds go beyond that. Pension funds actually play a critical role in the economy of any country. And amongst those things is the fact that they can invest in the productive sectors of the environment, in the productive sectors of the economy and improving living standards. If we look at, say, even Social Security in the Gambia, we know, for example, they've invested, say, in the GTSC. When the former GPTC went bankrupt, they stepped in, took over that institution and reinvested funds in there. Not only allowed the business to continue, but also continued with the people who were working and recruited, and they now have almost 400 or so staff. So that is one of the functions of a Social Security. They've done that with other institutions like GP, Gambia Petroleum, for example. And there are other investments they've done, even if they are not successful, but it's just demonstrating what Social Securities can do. They can also be very instrumental in supporting capital markets because they are institutional investors, and in the buy side of capital market, they provide a liquidity, and liquidity is essential for a successful capital market. So I know in the country, we are inaugurating, or we should be starting our own capital market this month. So if you have players like Social Security, because if there is no liquidity in a capital market, it will only be existing by name. It will be very difficult for it to function. So Social Securities play a significant role in that. They also mobilize funds because of the long-term nature of their funds. If you look at Social Security or pension funds, people enter pension funds at the age of, say, 18 or thereabout, and then go on till 60. So you really have about 42 years of your life investing in a fund, but to which you do not have access to the funds. So that is a long tail business, and it allows them to actually invest in infrastructure. So in a lot of countries, Social Securities actually invest in the infrastructure development of the countries. Like here, we've been talking about PPPs for quite a while now. In a lot of countries, one of the key institutional investors in PPPs are Social Securities. They can also reduce public borrowing, and they do this generally because of the productive sectors they're creating. And by that, they're increasing and expanding the tax base of the country. And so these are the benefits. So I just thought, just to put that out, so we have a common understanding of what the the benefits are before we go into what is available in this country and the challenges. So the next point is really just to talk about what are the models available, what are the pension pillars. There are about 5 pension pillars according to the World Bank. I've only referred to 4 here. The 5th one we're not going to consider. The 5th refers to, it's just the social protection that the government provides. For example, when the NDMA tries to assist people when there is a disaster, that will be categorized as Pillar 5 in the whole social security framework. But in terms of pensions, what you have is Pillar 0, which is the base. This is really like a universal pension. This is what avails pension to every pensionable age. So anybody who is over a pension age, there is a minimum pension provided. Now, we do not have this in this country. You will have this mostly in advanced countries. If you're familiar, say, with Canada, this is the pension structure they have. So you have a universal base. This is normally funded from your recurrent budget. Then you have Pillar 1. Pillar 1 is the social insurance. That's the mandatory bit. This is what we have here. You have the social security, which is providing the provident fund and the pension fund. And then you have the public service pension fund, which is catering to government employees. So that is what we have. It is mandatory and it is only for the formal sector. Unfortunately, in this country, the majority of the workforce is actually outside of the formal sector. So social security or pensions in this country is only covering about 200,000 people of the 465 or so thousand people active workforce. So about 60% of the country is actually not covered. So that's what we have. And then on top of that, you have Pillar 2. Pillar 2 is a complementary scheme. It can be mandatory, but generally is voluntary. It is here in the country, but only most banks here would have this Pillar 2 because they have a company-sponsored pension funds internally, including the central bank. They have this to complement the social security. So that is Pillar 2. And then you have the Pillar 3. Pillar 3 is it's voluntary. This is people with higher levels of income tend to go into this thing. We don't really have it here, but if you say people in America would be familiar with IRAs in America. IRAs would be in this pillar, or if you're in the UK, you're probably familiar with ISAs. ISAs are also this pillar. This is the pillar 3. And so these are the tiers available for pension. As your income improves, you will see people will progress to the various pillars. So the higher your income, the more you go towards the pillars, and the more benefits you have. So that is the framework of this thing, pension funds. So what do we have in the Gambia? Gambia, retirement plans in the Gambia is structured in 3 forms. The Social Security Act, which was established in 1981, took over from the State Pension Board at the time. It's mandated to do 3 things. One is to do the Federated Pension Scheme. The Federated Pension Scheme is a final salary defined benefit scheme. So i.e. it pays a monthly pension on retirement. So when you retire, you get a lump sum, generally 25%, and the rest is commuted and paid to you over the remaining period of your life. That's the Federated Pension Scheme. It is available mostly to state-owned enterprises. You do have few private sector in it, but I think it's only probably Trust Bank is in this particular scheme. It's not restricted. Any employer can join, but this particular scheme, the contribution is fully paid by the employer. So generally, private sectors are not in this scheme. It is covering about 16,000 people or so in this particular scheme. It's a defined benefit, like I said. So the risk of this fund is on the employers. Unfortunately, in this country, not many employers actually understand that risk. They're not even recognizing it in their books. the liability of the pension fund, because actuarially this particular fund is in deficit, and that actuarial liability should technically be reflected in their books as a liability. But most employers are really not aware of the risk they carry for this. That is why a lot of multinationals some years ago actually actively went on moving people from a defined benefit scheme to a defined contribution scheme. So, which is the next fund, which is the National Provident Fund. The National Provident Fund is a defined contribution scheme. So your contributions are certain, but the final benefit really depends on the performance of the fund over your active employment life. Most private sector employers are in this fund. This particular fund is where you have employer contributes 10% currently, and the employee contributes 5%. The federated pension fund is a 15% contribution purely by the employer. The provident fund is 10 employer, 5 employee. Your contribution is known. What you actually get at the end is depend entirely on the performance of the scheme. The third fund is an injuries compensation fund. It's an insurance for workplace injury. It is contribution fully by the employer, either $1 say or 15% of your salary. 1% of your salary is paid to the scheme, and it covers injuries, it covers death, disabilities, whether permanent or temporary. That is what it covers. So it's effectively an insurance for injuries. Then you have the public service pension scheme. This is the National Provident Fund covers about 130,000 people to 140,000 people based on the last available data. The next one is the public service pension scheme. This is for government employees, and this is actually managed by government. This is an unfunded scheme, so it is actually paid from government's recurrent budget. It is covering about 41, depending on the number of government employees, but about 50,000 people. That's what it's covering. And then, like I said, finally, which is what I talked about, the pillar 2, the pillar 2, which is the employer-sponsored private schemes. These are generally with the banks, some multinationals here, and certainly the central bank. So these are the schemes available. Employees do not have a choice here. So it's not like it is not like, say, in the US, or when you have a 401k, you can make specific selection as a type of funds you want to contribute. In the Gambia, that's not the case. The choice is purely with the employer. The employer decides which of the two funds with Social Security to join, either the Provident or the pension fund. But like I said, it is almost by default, all parastatals join the federated pension scheme, and all private sector join the National Provident Fund. So those are the schemes. That's what's available in the country. And so the next slide is the risks covered. There are effectively 3 risks covered. First is the accidents and invalidity. This is what I talked about, the injuries compensation fund. This is the workplace accident. And then there is old age and death. So old age, death is also under the injuries compensation. So if an employer dies whilst in active service, it's covered by the injuries compensation together with whatever they have in the schemes they are in, whether it's the pension or the provident fund. And then old age is pension. So if you are on the provident fund, you get a lump sum payment at retirement, which is whatever is contributed for you and whatever income is generated over your working life. And then that is either when you are in the when you're in the pension fund, if you die, that's the end of it. But if you are in active service and die, you're covered by the injuries scheme. So these are the funds available. Now, then we look at what are the challenges of retirement in the country. I think there are a couple of challenges here. Like I said, 60% of the active workforce is not in a pension scheme. So imagine all those people in the informal sector. If they attain the age of 60, there is tremendous level of difficulty in this country because they have nothing to fall back on. They're completely dependent on the family or on the people who are actively working to support. So I think, and that dependency actually makes it very difficult for people in working life to think of anything else apart from their immediate problems. So actually start thinking about what else can I complement my current retirement portfolio with, i.e., supplementary savings. So that's difficult. That's not available. And also because of the informal sector, like I said, the significant number of people working here are in the informal sector. When you are in the informal sector, yes, there is a provision within the Social Security to take you on, but because people are not aware of this, they're really not joining the schemes. So again, the informal sector makes it difficult for people to join. There's also a high level of unemployment. And that high level of unemployment actually also makes it extremely difficult. And there is currency volatility. Now, if I give an example, in 2002, the Social Security portfolio was about, it was somewhere around $50 million in 2002. It's about $50 million. With a membership at that time of about 115,000. Today, at 2021, the portfolio is about 130 million. That is some 21 years after. Sorry, some 22 years after. It's 150 million. Now, compounding, I think most people will be aware of compounding. I hope people around are aware of compounding. If not, I mean, compounding is one of the things Einstein referred to as the eighth wonder of the world because of what it can do, saving small amounts of money to actually give you a significant amount at the end of the time. So if we had taken that 50 million in 2002, and just without any other investment on top of it, and you were to compound that at, say, 10% per annum, which is not unrealistic. I mean, Treasury bills have been, until 2017, they have been nowhere below 10%. In fact, in the early parts of 2000s, Treasury bills were somewhere around, in fact, at one point they touched 34% per annum. And even in 2014 or so, around 2016, they were somewhere around 24%. And even 2016, they were averaging around 15%. So realistically, 10% is a very conservative number. But even if you take 10 and you are compounding the 50 million, it will give you somewhere around 100. It should give about $130 million without any additional injections on a 150,000 workforce. To now, with about 160,000, the portfolio is somewhere around, based on 2021 numbers, it's somewhere around $160 million. So really, you can see how the impact of currency has had on the portfolio. So even if I had taken the contributions people would have made, the fund should somewhere be certainly north of $300 million with the compounding, with the contributions, and the increase in the number of membership. But it is right now sitting at somewhere below $150, $160 million. So that's an impact of a couple of things. One is certainly the impact of currency, but also the high cost of running the fund. The fund is probably running at somewhere around a 30% total expense ratio. If you compare that with what is available in Sub-Saharan Africa, the expense ratio of actively managed funds is somewhere around 10%. Now, if you go to the Western world, an actively managed portfolio, the total expense ratio for actively managed portfolio is somewhere around, it's under 1%, maybe 0.9, 0.95%. Now, there are various reasons for this, but ours is seriously inefficient. And we need to see how, I mean, if I were to ask people around who are participants of, say, the retirement portfolios here, I will be surprised that many people are actually following. Even if I were to ask, when did you last check your statement? I am sure I'll get a negative response from most people, even though you're contributing 15% of your income on a monthly basis, which you will be doing for probably 40 years of your life. You have absolutely no idea how much of that is there for you. And you have absolutely no idea. And there's no certainty you'll even get your money. Because like I said, your contribution is defined, but your benefit is not defined. If you are on the Provident Fund, you will get what you get. You will get what's available. So I think it brings the other issue, which is literacy. I think one of the biggest problems we have in this country. I know when Mas talked about his presentation, he was talking about the banking access, or even the mobile phones. Now, I'm a little digressing, but I just want to bring in here to reinforce the point of financial literacy. This country has got a very high level mobile penetration. It's got about 67% mobile penetration, about 1.4 million registered mobile users. But yet, AfriCell, AfriMoney, and QMoney have been in this market for probably the last 3, 4, 5 years. And their penetration is under 2%. Because not only, one, because of literacy, but also because there is a lot of friction with this mobile money. So I think, so that literacy comes to fore. I mean, you continuously see the impact of financial literacy. And I think that's what we need to really work in to improve the issues with retirement planning. If people are to understand, I mean, I talked about the 8 wonder according to Einstein. If people were to understand the impact, like the informal sector, even if they were to contribute, say, $10 per day on average, and that's not challenging. It's not challenging because most of these people will buy a time once a week, twice a week. That's like $50 is twice a week if you do it twice a week. If you were to contribute a similar amount of money on a monthly basis and you have it being properly managed, clearly it goes with the management, at even a 7% compounding return over the period of their retirement, that money can account to almost close $1 million by the end of the period. Now, but a lot of people do not clearly appreciate this because of the literacy challenges that we're talking about. So I think this is the area that people need to understand your portfolio, understand what you're investing towards, understand how it is impacting or how management of those funds are being impacted, and therefore what your expectations are. I mean, if I am putting my money somewhere to manage for me, I will clearly take interest in it. So I think that is important for people to understand and appreciate that, and then build on that. Now, I talk about the literacy. Sorry, I'm trying to. So the literacy law, it will help people. It will enable individuals to make informed decisions about their money and savings. It will certainly lead to higher participation in retirement. It's not about I cannot do it. And I think to enable this thing, to make it effective, is actually government and in partnership with other institutions, is really to introduce financial literacy programs, targeting students, targeting community groups, and targeting general public to increase participation. It is surprising that even people with a finance background, you may have the technical understanding, but there's a lot of people even with financial background who are actually financially illiterate. They're terrible in their own management of their own finances or planning their own finances, or even taking interest in some of those things. And if you have a very weak retirement portfolios. If people are not properly invested in these things, it actually has a significant impact on economic growth and economic development. People sometimes don't see the link, but there's a very obvious link between the two. Like I said, retirement portfolios mobilizes funds. A lot of banks have very short-term funds. They cannot really go into any long-term lending because of the significant mismatches they will have. Retirement portfolios can do it. Retirement portfolios can actually fund, and a lot of countries have used them. I mean, Singapore, for example, have effectively used their retirement portfolio to generate wealth for individuals. And that wealth generation for individuals has a significant impact in driving economic growth of Singapore. And it's not only Singapore. There's a lot of countries around the world who've done exactly the same things. And I think if we as a country were to take a concerted effort towards this and then enhance people's knowledge in financial literacy, I think we can actually make a significant difference in the country's economic growth. Now, so how do we actually go by doing this? One, a government action. Government need to increase participation. Like I said, we need to increase participation. We need to find ways of bringing in the informal sector. I mean, the informal sector is actually driving this economy. Over 60% are participating in that sector. We need to bring them in. We need to find a way of bringing them in. There needs to be a collaboration between financial institutions, insurance companies to kind of structure products that will entice and bring these people. But you couple that with the training. You couple that with the literacy programs. It is also about we talk access to financial services. I mean, Gambia actually within the sub-region is the bank population of this country is about 5% of the population. This is the lowest in the sub-region. I mean, places like Ghana, for example, they've got like 34% of the population banked. Even places like Benin, they've got 8% of their population banked. But Gambia is about 5% of the population. Over 60% is unbanked. Whether formal, informal, whichever way you look at it, even at the village level, they're unbanked. So clearly, fintech can play a significant role. Fintech can play a very vital role in bringing these people on board. Because if we don't have this, if we don't have ways and means of people having an avenue to put in money, even in that small flag, because you have to be able to do it at a reduced transactional cost. And the only thing that can do that will be fintech, to allow people an opportunity to have an avenue to capture their savings, and then mobilize those savings to, you can use it to lend back to society for growth, because like I said, it's a long tail business, so they can afford long-term lending. So I think if we do that, combination of all of these things, government has a part to play, industry has a part to play, but the community has a part to play. It's probably about time that we start looking at, say, schools. How do you introduce this? I mean, a lot of countries are doing that because a lot of countries have recognized that literacy, financial literacy, the critical importance of financial literacy. A lot of countries have now recognized that, and they're taking active actions to make sure that the people have a knowledge of this thing and see how they can introduce it to the society. Now, finally, my final slide is really just talk about the way forward. I talk about the implementation programs. This is very specific targeting, collaborations among governments, financial institutions, civil societies. I think everybody needs to come to board. And also incentivizing people. There must be a pull factor. If we want to get people into this thing, there must be some kind of pull factor. There must be something that bring them on board, to really see the importance of this thing, and they need to invest in it. I think this is what it is. I think it will probably be better to lay the foundation and maybe have an interactive discussion to deal with some of the points. So thank you. That I think that will be it.
Thank you so much, Mr. Manjang. That was very informative. I'm sure everyone watching and listening have benefited a lot from all those details. My question to you is, how much of this information is available to folks before they make these retirement elections? I've worked in the Gambia for a number of years, and it's interesting that you're giving all these details. I don't recall having all this information when I was well, I don't have a choice to make the election, but at least I should have some of this information at the time to be able to make informed retirement decisions and also planning. So I'll be interested to know how much of this information is available to people at the time that they're eligible, including, whether there are any early encashment options and whether there are any penalties attached to that, and whether they have even option to take loans from their own social security funds and pay them over time.
Yeah. Okay. First, the question. Availability of the information. And the information is available. I mean, the Social Security Act is a public document, so it's available. The current website of Social Security actually also provides a lot of information. But I think the problem with retirement planning is it's always in the back burner for most people. See, you come to employment, you are young, you are 18, 20. Who is thinking about 60 years down the line? Our long-term planning, that's not in our minds. We really don't think 60 years down the line. We don't. It doesn't cross our mind. Most people, retirement only comes to mind when they are in their 50s towards retirement. That is when they start thinking about time. But by that time, it is already late. But I guess that's what I'm saying. I think that is why I'm saying people may have the technical understanding, but that does not make them financially literate. And I think it's about time. Like if I were to ask you, Bakari, when did you check your Social Security Provident Fund statement? Probably, if you do, probably long time ago.
Yeah, over 10 years or more.
Yes, exactly. Did you ever? I'm sure if I were to ask, have you been asking? You'll probably tell me, no, I don't really ask, because it's at the back of your mind. You're not really consciously thinking of it. But if I were to tell you, you run the risk of actually not even getting what you've invested. Forget it. I'm not talking about returns. I'm talking about your capital, that your capital is at risk. Now, most people don't know that, but every single person who is on the Provident Fund, actually your capital is at risk, because it's only your contribution that's defined. Your benefit is not defined. It depends on the performance of that fund. So the employers are not taking interest. Employees are not taking interest. So I think it's about people. I mean, the Provident Fund is about, right now, it's about over, I think it's probably $4 or $5 billion. It's all invested locally. Currency depreciation is impacting it. It's not actually generating much return. I think from 2015 to date, it probably only paid 2% return for that entire period. But like I said, over that period, Treasury bill rate at some point was about 30%. Up until 2017, it was at least 15%. It only dropped below 10% in 2017 to now. So I think that's the thing. So I think it's about people taking active interest. This is your money. It's nobody else's. It is your money.
Right. You made a very interesting point. I remember a couple of years ago, I was in Parliament. He started one of the state enterprises. So we went for the PAC meeting, and I recall one of the subject matter specialists, Mr. Njai, very smart old man.
Mm.
He made a comment. I believe this was I don't want to mention names, but when he looked at the entity's books at the time, he said, "Well, you're seeing all this liquidity now because the number of people generating into the retirement age at this point, it's limited. But in the
Yeah.
next 10, 15, 20 years, you have a surge of all these,
Mhm.
people, graduating into retirement age. Then you would realize that you don't even
The
have
problem.
the liquidity, yes, to
Yeah.
be able to deal with all those payments. So I'm glad you brought that
Yeah.
point
In
because that
fact,
really
in
stuck with
fact,
me.
yeah. In fact, right now,
Yeah.
you have about 5,000 people in retirement on the Social Security funds. 5,000. You have an active workforce of about 150,000 there. It is still a very immature fund.
Right.
So the contributions that are being received are more than enough to pay the outgoing. But Social Security, on average, is running at about 30% expense ratio. That is extremely high.
Yeah.
You add to that all the non-performing portfolio because of what happened with the former regime. It creates a lot of challenges. I see somebody else was asking a question about housing finance. No, sorry, you asked another question about whether the fund, the regulations right now do not allow for people to borrow against their retirement portfolios. But I mean, this is something when really government should give serious consideration to. I mean, Singapore, one of the best ways that they've used to actually grow that economy, just wealth, individual wealth, is to allow people to borrow against their social security funds to invest in housing. But here, I mean, our other challenge is just the contribution levels are low because salary levels are low. But this can be supplemented. I mean, if people will understand how they can create wealth through this, I'm sure a lot of things can happen.
Yeah. In fact, here in the US, we have that option with your 401k. You're able to take residential or even personal loans and pay it over a period of time.
Yeah.
But the other thing that I also wanted to ask with the investment option, in the Gambia, you don't have the choice to decide where those funds are invested. Like in my 401k, by default, you'll have investments that they would default to, but you have the option to go in there and choose
To pick.
different
Yeah.
portfolios if you don't want. So,
Yeah.
so how? I mean,
That
how
is
do we?
pillar two. That is why you are able to do that. It's pillar
Right,
two.
right,
But US also have the Social Security, which
right,
is the base, which you
correct,
do not have an option to what to pick. That is pillar two. Sorry, that's pillar one. So
right,
that's what we have. It's pillar one. It's going to be difficult to allow people to make a choice because this is trying to guarantee some basic minimum thing. But
gotcha.
having said that, I think individuals should take interest. I mean, I know Social Security normally organizes like a members forum. It's like a kind of like an AGM. I mean, if you were to mirror it, you'll make it like an AGM. But members don't turn up.
Mm,
I
interesting.
think people need to be educated to actually take interest in this. Because you see, in the Gambia, when people go and retire, it's unfortunate. People work for 40 years of their life. They go in retirement within 3 months, they're destitute. It doesn't matter what level you retire. That's what happened to most people. And then what happens is we then fall back on society, which is effectively our social security. But by doing that, we're actually curtailing the ability to invest, the ability to save. And a country without savings is going to be very difficult to grow. You need to actually build a healthy savings base to have economic growth. They go hand in hand.
Excellent. Thank you, Mr. Manjang. My last question, you spoke about the federated pension scheme reporting a deficit at this point, in which of course has the impact of all the related entities in that scheme to report those liabilities in their books. I know here we have what we call person tours. It's mainly for the states, but technically I think it's a similar concept. So for each of those entities, the state would kind of do an actuarial valuation, and also depending on the staff demographics and all others, they would kind of make assumptions as to life expectancy and all that, and then determine for every one of those entities under the state how much is their liability that they should be recognizing in their books. Probably this is something we are going into finance, but because that's important for those entities to reflect those liabilities in their books. And given that the financial regulations in the Gambia are not very strong, what measures do we put in place to ensure that entities like that are really reflecting those liabilities in their books?
Yeah. Funny, I don't think it's even about the financial regulation not being strong or not, because most of these businesses are under IFRS, and IFRS provide provisions to account for this. I think the problem is not understanding the risk or not knowing the risk. I think it's a knowledge issue as to unwillingness to do it. Because you see, they, as far as they're concerned, they have a 15% obligation which they are paid. But what they do not quite appreciate is that they are on a defined benefit scheme. And because it's a defined benefit, your contribution is not the point. It is your terminal liability which is of importance. And once you do that actuarial valuation and there is an actuarial deficit, that deficit should be funded on top of your normal periodic contributions. And some organizations will have a agreed period to pay over this deficit, and so you plan it and say every year on top of your normal contributions, you add a portion to kind of cover that actuarial deficit. But I think it's a knowledge issue. I think, and this is what I'm talking about, is really just educating people so they understand actually the level of liability that they because they're not really, most of these parastates are really not reporting that aspect of the liability, and it can be, I think it can be significant.
Absolutely. Yeah. Interesting. Excellent. Thank you so much.